Morning. On behalf of all of us at Hill, I really appreciate you guys showing up this morning. I'm really excited about a very special speaker that we have. I guess it was July or August when the market started to change. Prices stopped going up quite as fast. Maybe there were some price reductions. Interest rates decided to keep going up and keep going up and keep going up. And I said, we got to do something. I need to bring somebody in to bring some calm in this market, right? Because if you turn on your TV, it's bad. If you turn on the radio, it's bad, right? So who's somebody that really knows what's going on? Who can come talk to us and tell us? I remember David. So I saw David, as with all of us, we saw David in Vegas in the spring, and David's like the most knowledgeable person I know in terms of what we're going to be talking about today. So I heard David, and I got so excited that I took his slideshow, and I was going to come back to Birmingham and completely rip him off, and I was going to go teach all you guys what was going to happen in the market. But I can't deliver quite like David can. So, without any further ado, this is David Battany. He's our EVP of Capital Markets, and anyway, here he goes, guys.
Thank you. As I say that Amy was a really smart guy to come today. Unfortunately, he was unavailable, so I'm here instead. So in my role at Will, I run our capital markets group. So I manage all of our relationships with agencies, and I do a lot of work on housing policy issues. I spend a lot of my time in Washington, D.C., working with Fannie Mae and Freddie Mac, HUD, agencies, also with members of Congress on different issues. I'm chairing several committees that the industry has for affordable housing and first-time home buyers. So a big part of my career was at Fannie Mae. I worked there for 22 years. So if you have any question on any issue about the industry, about products, about how government's interacting with housing, hopefully I can share insights with you. I've been in capital markets for 30 plus years, and so there's been worse times than this. But there's a lot of hysteria in the headlines, and a lot of that's impacting, the home buyer watching the news yesterday or today is going to have just a lot of questions. What I'm hoping today is that this gives you just some facts and help control the narrative and not have the media always control the narrative about home buying. And what we have here in the PowerPoint today will be sent to each of you. So if I'm blocking the screen or you can't quite see something, don't worry about it. But I hope at the end of the day, as you leave this session, if you have questions from a home buyer about, is this the right time to buy? Should I wait because interest rates are high? Should I wait for a while? Or I know home prices might be going down. I see that in the news. Should I wait? I just want to give you some good information to help have that conversation. Because at a time like this, we went through the biggest refi boom in history. It was a very busy purchase market last year, just a crazy, frothy market. A lot of people entered the business that are not professionals, that people that were recent additions that really just sort of process transactions. In a market like we have now, where things are thinning out, this is when professionals really rise to the top. And a consumer making a decision to buy a home, it's the most important financial decision of their entire life. And the role you play of not just processing the transaction, but really helping them understand what they're doing, have eyes wide open, help frame the issue, answer their questions, and really give them good information to make this important decision. This is where your professionalism really shines. So I hope today just helps give information for you on that. If there's any part of anything we talk about and you're not quite sure, raise your hand. I love questions, I love interruptions because you can't talk and think at the same time. So I can pause and take a breath and think. It actually helps me. So feel free to ask questions as you go through it. And I want this to be more conversational and not just like a professor over here throwing a bunch of facts at you. The first few slides will feel a little bit professorial, but I want this to be more conversational. So what I want to do is just kind of share kind of how we got here, just really quickly, and that'll help us understand where we're going to and help you better answer questions. So when COVID really hit the country, it was March of 2020, and that's when we had the full government shutdowns. So it seems like it was a million years ago, but it was only March of 2020, and It was really in January we started talking about it. Like as a whole country, we knew something was happening. We weren't quite sure if we were taking it too serious or not serious enough. But March was when really the shutdowns happened. So in March, the Federal Reserve jumped in and they did two main things that really impacted our industry. And so what those items were is they wanted to stimulate the economy, they wanted to lower interest rates was their objective. So what they did is they lowered the Fed funds rate, and that's what you hear about in the news all the time. And they also bought a bunch of MBS. So we'll talk about them really quickly. The Fed funds rate, this is literally a one-day loan between banks. Every bank at the end of each business day, they have to have so much cash reserves on their balance sheet. And every day, people come in, make deposits, make withdrawals, and the banks at the end of the day, because they were to shut down for the day, they may be under or over their target. So what banks do, if one bank's over, one bank's under, they make an overnight loan to each other. So one has extra reserve, this loan to the other bank, and they borrow it at 4 o'clock in the afternoon, and they pay it back at 9 o'clock the next morning. It's a one-day loan between banks, just when you manage the balance sheets. But the Federal Reserve determines what interest rate that is for a one-day loan. And so by moving that rate up and down, they can kind of control the cost of funds for banks. Because if that rate goes up and down, that's what banks are paying to borrow money for one day. And then they pass that through on what they charge to their customers for bank loans, whether it's a business or a consumer, they pass it on. So the Feds always have this as a tool that they can, whenever they want, they can turn it up and down and control interest rates in the economy, mostly short-term rates. It's a one-day rate. So when they raise or lower this, short-term rates like the prime index, if you have a home equity line of credit, that is tied to short-term rates. A lot of business loans are tied to like one-day rates, 30-day rates, 60-day rates. It doesn't usually impact mortgages. Mortgages are priced out more towards longer-term rates. So when they raise the Fed funds rate, it really has little or zero impact on mortgages, but it makes the news. The Fed had a meeting last week. They raised it 75 basis points. You probably had people saying, hey, did mortgages just go up 75 basis points today? They didn't. On some days, mortgages might go up a little bit, but many days might go up zero. So it's important to know because it makes a lot of news. The answer to a consumer is it's a one-day rate. It doesn't really apply to 10 or 30-year fixed rate loans. So it has a little bit of impact. When the Fed raises it, they're telling the markets they want rates to go up. So it kind of pushes all rates up a little bit psychologically, but it really doesn't have a direct impact. So that's the Fed funds rate. Any thoughts or comments or questions? I mean, are you guys getting people asking about that? Hey, I saw the news today, Fed's raising rates. It definitely creates a lot of misunderstanding. So when the Fed lowered that, when COVID hit in March of 2020 and the shutdowns happened, the Fed took the rate down to zero. So banks could borrow to and from each other for zero interest. They were doing that, trying to make banks have a low cost of funds, hoping the banks would charge low rates for their loans, and that would help stimulate the economy. The second thing the Fed did that really applied to us in the mortgage industry is they wanted to lower interest rates on mortgages. So every lender today, when they price their rate sheet for fixed rate loans, they price them to Fannie Mae, Freddie Mac, or Ginnie Mae prices. So Fannie Mae, Freddie Mac, and Ginnie Mae issue securities, and those trade in the market, and the price of the securities gets translated to a rate sheet. So every morning, my team wakes up, I look at what the price of a Fannie Mae security is, and I do some translations to turn that price into a rate sheet price. And so if we have a 6.5% note rate today, that's based on a certain security price that that loan would fit into. I look what the security price is, and that goes into our rate sheet. So tomorrow, if we wake up and the MBS prices are a half point better with Fannie Mae, our rate sheet gets a half point better. That means whatever rate the borrower was looking at yesterday, the fees for that rate just got a half point better. It's either a half point rebate to them, or if there's a discount, that discount just got reduced by half a point. Every single day as the MBS market goes up and down in price, a lender's rate sheet goes up exactly the same amount. So that's why MBS is important, because it determines where interest rates go. So, an MBS, or mortgage-backed security, trades in the bond market. Pension funds, investors buy these bonds, and they just own these in their portfolios. And so what the Federal Reserve does, they come in and kind of like elbow their way out and say, okay, we're going to be buying a bunch of MBS. So what they decided to do when COVID hit is buy 40 billion of MBS every month to push the price up. Question, Beck?
You said MBS, can you explain what an MBS is, just more?
Sure, absolutely. Yeah, MBS is an acronym for mortgage-backed security. So literally the way it works is you might take 10 loans, each one's $100,000, and they have a group, and that group is then sold into what's called a pool, and it's a $1 million pool. And whoever buys it basically is getting whatever interest those mortgages pay. So each of those mortgages is paying 5% interest. That flows through to the buyer. So it's just a way a lender can make mortgages, put them into a group or a pool, sell them to an investor, get paid cash, that cash comes back, and you make new loans. So pretty much most mortgage bankers are doing this. If you're really large like Guild, you create your own MBS. If you're small, you sell to someone else who puts it into an MBS for you, and it does that. So it's just a way to kind of create an endless cycle of cash coming in. The other way to do it is the old-fashioned way, which is a bank has a portfolio, a bunch of checkings and savings accounts, a bunch of money, they lend it out, make loans, but then once they make loans, they can run out of money. They don't have more checking accounts coming in the door. So banks have always done that the old-fashioned way for a portfolio, but the downside is there's not an endless supply of checking accounts. If you do MBS, you can make loans on the MBS market, these bond buyers buy it, and you just have an endless supply of recycling money. So pretty much every lender today goes through this fixed rates. This pricing is to Fannie Mae, Freddie Mac, and Ginnie Mae. So when the Fed did this, they had two objectives. They wanted to lower interest rates, and they wanted to do two things. First one is they wanted to raise the inflation rate in the economy up to 2%. When COVID hit in March of 2020, inflation was about 1%. If you're the Federal Reserve and you want to have a really strong economy, you don't want inflation to be too high or too low. If it's too low, people just sit on their money and the economy can stagnate. If it's too high, it's kind of crazy to price interest loans for investors. If you want to expand your factory or grow your business, when interest rates are really high and inflation is really high, it's really hard for investors to make long-term decisions to invest. They can make short-term decisions. They're comfortable where inflation is going to be for the next few months or a few years. But if you have economies, something like Argentina is an example where they've had perpetually high inflations for decades, pretty much no investors invest long-term into Argentine investments. And you cannot get long-term fixed-rate mortgages in Argentina. You get short-term ARM loans. So high inflation can be very bad for an economy, and zero can also be bad. So they thought 2% is the magic number. High enough, people will just sit on their money, but not so high that it creates crazy, fears for investors not to invest money. So they had a target of 2%. So that was their first target, to bring inflation up to 2. And then their other target was to bring the unemployment rate down to about 4.5%. They didn't say the exact number. They called it full employment, but it's about 4.5%. And this is the worst part of my entire presentation. This is all the economics we'll get out of this in a second, the fun stuff. So they bought a bunch of MBS, trying to raise inflation to 2 and lower unemployment. So what happened? I think you can probably see this in the light. This number here is the unemployment graph. This is March of 2020. The report always comes out a month later. So unemployment was in the 3s. Then the April report comes out, and people have just lost their minds. It went from the 3s up to 14% in 1 month. Just to put this number into context, the highest unemployment rate ever in the United States history was during the Great Recession, when it got to 24.9%. So here we got more than halfway there in 1 single month. This is when we're thinking, okay, zombies are going to come out, get your shotguns, get barbed wire. It's going to get really scary. So in hindsight, the history books will say the Fed probably was too aggressive, but at the time they really didn't know. No one knew how bad. All you knew was this, where's next month going to go? Is it going to be up here? It was a very scary, very uncertain time. What you can see is the unemployment rate started dropping, and we're down into the mid 3s. Most economists say you'll never get zero unemployment. There's always some people that move jobs, have nothing to do with the economy. Personal decisions in their life, they're switching jobs. not because the job market's good or bad, the economy's good or bad. So most economists think you really can't get below 3.5. So when you say full employment, there's no clear answer, but most economists think 3.5, 4, maybe 4.5 is kind of in that range. I'm a history geek nerd. Anybody want to guess when the lowest unemployment ever was in US history? It was 1944, when our entire economy was just in full speed for the war effort. It was down to 1%, in the 1% hands. So that was crazy low, but most people today think a 3%, 3.5, 4 range is kind of about where it should be. So the Fed has really hit the objective. What's really interesting and kind of scary is there's 10.7 million jobs posted today by US companies posting a job that are unfilled. This is more than every human in the United States that could come back to work. We have almost 2 jobs posted for every person that might want to go back to work. So it's really good if you're an employee looking for a job, but it's not good for the economy, because when you have such a tight labor market like this, what it does is it creates upward pressure on wages,